Imagine buying like a gorgeous $500,000 mountain cabin.
Oh, yeah. The dream.
Right. And you use money straight from your retirement account to do it.
Mm-hmm.
But here's the kicker. You legally pay absolutely $0 in taxes on that massive withdrawal.
Which sounds completely made up, I know.
It really does. I mean, it sounds like an illegal internet cheat code or one of those sketchy courses you see on social media.
Yeah, the guy standing in front of a rented Lamborghini telling you how to beat the IRS.
Exactly. Your immediate instinct, if you have any financial common sense, is that taking a huge distribution from a pre-tax retirement account without paying the IRS is just a fantastic way to get yourself audited into oblivion.
Oh, absolutely. I mean, an audit is the first thing that comes to mind.
Right. But the reality we're exploring today in this deep dive is, well, it's far more complicated, and honestly, it's far more fascinating. Because that specific scenario, it's entirely real.
It is real, yeah.
It is completely legal under the U.S. tax code.
But
it is an absolute minefield.
Minefield is probably the most accurate description you could use. I mean, we are talking about a highly sophisticated tax and financing strategy here.
Right.
And precision isn't just, like, recommended. It is literally the only thing standing between an investor and a catastrophic financial penalty.
Because you're playing with fire, basically.
Yeah, you are blending two of the most heavily scrutinized areas of the IRS code: retirement distributions and real estate losses.
So if you're listening to this right now, whether you're trying to figure out how to diversify your portfolio, or maybe you're looking for a way to break into real estate.
Or just insanely curious about how the wealthy play by a different set of tax rules.
Exactly. Then this deep dive is absolutely for you. Because our source material today is, well, it's the ultimate map through this minefield.
It really is.
We're analyzing a comprehensive guide from April 2nd, 2026. It was published by Jhenesis Mortgage. Written by Stacy Ann Stephens, who is a mortgage broker with an MBA. And she specializes in exactly this kind of complex investment financing. The guide is titled, STR Loophole and IRA Funds for Investment Property. Complete guide.
And, the value of this specific source material is that it abandons all that theoretical guru talk.
Oh, thank goodness.
Right. It dives straight into the brutal real-world math. It looks at the intersection of tax law, specifically IRC Section 469, and modern real estate financing tools that, frankly, most casual investors don't even know exist.
Which brings us to our mission statement for today. Because over the course of this deep dive, we are going to map out the incredibly specific, non-negotiable requirements of the so-called STR loophole.
STR meaning short-term rental for anyone.
Right, short-term rental. We're going to decode how you can strategically finance one of these properties using specialized loans that actually ignore your personal income.
Which is wild to think about.
It is. And most importantly, we are going to highlight the disastrous, incredibly expensive traps that catch out first-time investors who think they can just, wing this strategy.
Because you cannot wing this at all.
No, you can't. By the end of this conversation, we're going to arm you with the exact questions you need to ask your CPA before you ever sign a single document. But I have to start with the obvious question.
Go for it.
If this loophole is totally legal, and it can mathematically erase the taxes on huge IRA distributions, why isn't every single person with a retirement account doing it right now? I mean, it feels like it should be front-page news every day.
Well, the barrier to entry isn't illegality. It's not that people can't do it legally.
Right.
The barrier is extreme, meticulous compliance. I mean, the United States tax code is remarkably unforgiving when it comes to granting exemption.
You don't just hand out free money.
Exactly. If a single element of this strategy is misaligned, like if your financing structure is slightly off, or if your timeline for putting the property into service slips by even a week.
Just a week?
Just a week. Or if your daily time logs aren't properly documented, or your personal situation doesn't match their rigid definitions, the whole plan just implodes.
Oh.
It's like a combination lock, Having 3 of the 4 numbers right doesn't get you a partial tax break.
Right. The lock doesn't open.
It gets you a massive, unexpected tax bill and potentially a very painful audit.
Okay, so to understand why this combination lock is so fragile, we need to first figure out the core mechanism that makes the lock turn in the first place.
Right, the mechanics.
We have to move away from the glamorous promise of, tax-free cabins and look at the actual IRS rules. Let's talk about IRC Section 469, because it seems like the entire strategy hinges on the difference between the word passive and the word active.
Yeah, Section 469 of the Internal Revenue Code is the absolute bedrock here. To grasp the loophole, You first have to understand the general rule it's designed to bypass.
Okay, take us back. Where did this come from?
Well, historically, back in the 1980s, wealthy individuals were just buying up real estate that lost money on paper, purely to shelter their high incomes from taxes.
Ah, right. Classic tax sheltering.
Exactly. So the IRS cracked down on that heavily with Section 469. They created a rule stating that, by default, any losses you generate from a rental property are classified as passive losses.
Okay, I want to make sure I understand the gravity of that word, passive. From a taxpayer's perspective, like what does that classification actually do to my money?
It quarantines it. Basically, the IRS looks at your tax return and says, okay, your long-term rental property operated at a $20,000 loss this year on paper.
Mostly due to depreciation, right?
Right, depreciation, interest, things like that. The IRS says that's fine. But because renting out a house is considered a passive activity, you can only use those $20,000 in losses to offset other passive income.
Oh, wow.
Yeah. You cannot take those rental losses and use them to lower the taxes on the W-2 wages from your day job. You cannot use them to offset your active business income. And crucially for our topic today, you cannot use them to offset a distribution from your traditional IRA.
Because an IRA distribution is treated as ordinary active income, right?
Yeah.
So if I buy a standard rental house, sign a year-long lease with a great tenant, and my CPA says I have a $20,000 loss on paper, that doesn't actually help me lower the taxes on the salary I make at my office job at all.
Not one bit.
It just sits in a bucket labeled passive losses until I somehow eventually generate passive income to absorb it.
And that's the frustrating reality for the vast majority of real estate investors out there. It severely limits how useful standard rental properties are as an immediate tax shelter.
Right, the money is just stuck.
And this is the exact threshold where the STR loophole comes into play. The IRS treats short-term rentals fundamentally differently than long-term rentals.
Okay, tell me how.
Well, only if you meet two incredibly strict rules. If you pass these two tests, the property is actually removed from that passive rental activity quarantine. The tax code treats it as an active business.
Which flips the switch. So suddenly we are dealing with active losses instead of passive losses.
Precisely.
And if I'm following the logic here, active losses can be used to offset ordinary income.
Yes. Your W-2 wages, your business income,
and my traditional IRA withdrawals.
You got it.
So under normal rules, rental losses are like a gift card that only works at one specific, really boring store. You have the value, but you're incredibly restricted in how you can actually spend it.
That's a great way to put it.
But the STR loophole transforms that restricted gift card into cold, hard cash that you can spend anywhere. Specifically, you can spend it to wipe out the tax liability on a massive retirement withdrawal.
That transformation of value is the entire engine of this strategy. But the IRS doesn't just hand over that universal gift card easily.
Of course not. It's the IRS.
Right. You have to pass the two gatekeeper rules. Rule number one is a strict mathematical threshold. The average rental period across all guests in the tax year must be 7 days or fewer.
7 days or fewer. Not an average of 8, not a flat 10. 7.0 or less.
Exactly, 7.0 or less.
So how is that average mathematically calculated by the IRS at the end of the year?
You take the total number of days the property was actually rented out to guests during the tax year, and you divide it by the total number of separate rental contracts or, guest stays.
Okay, so give me an example.
Sure. So if you have a property on Airbnb and you rent it out for a total of 100 days across 25 different guest stays, you divide 100 by 25.
Which is 4.
Right. Your average stay is 4 days. So you comfortably pass Rule 1.
That seems straightforward enough if you're running like a standard weekend getaway spot. But before we get to Rule 2, I want to clarify something that the source text emphasizes heavily.
The RDPS distinction.
Yes, I know real estate investors get this confused constantly. How is this STR loophole different from REPS, real estate professional status? Because if you spend 10 minutes on any real estate investing forum, REPS is the acronym being thrown around as the absolute holy grail of taxes.
It's a vital distinction to make because confusing the two will lead to a disastrous audit.
Yeah.
REPS real estate professional status is a completely different, much older section of the tax code, and it is incredibly difficult for a normal person to achieve.
Why is it so hard?
Well, to qualify for REPS, you must spend at least 750 hours a year in real property trades or businesses.
Yeah.
And this is a real kicker. More than half of your total working hours for the entire year must be in real estate.
Wow. Meaning real estate essentially has to be your primary full-time profession.
Exactly.
So if I work a standard 40-hour-a-week W-2 job, like as a software engineer or a teacher, I am almost certainly never going to qualify for REPS because I'd have to work another 41 hours a week in real estate just to tip the scales over the 50% mark.
Yeah, the math makes it nearly impossible for full-time employees. But if someone does qualify for REPS, say a full-time real estate agent or a developer, the reward is massive.
Right, it unlocks everything.
It unlocks active losses for all of their rental properties, even standard long-term annual leases.
Okay, but the STR loophole we're discussing today is much more accessible than that.
Oh, absolutely. It does not require real estate to be your primary job. You can be a full-time software engineer working 50 hours a week and still use the STR loophole.
That's amazing.
It is. The limitation is just that it only unlocks active losses for that specific short-term rental property. It doesn't magically turn your other long-term rental losses into active ones.
Okay, that clarifies the legal boundaries. But stepping back for a second, I want to understand why the IRS makes this distinction in the first place.
The philosophy behind it.
Yeah. Why does a short-term rental get this special, highly lucrative business treatment while a house rented on a 12-month lease to a family is quarantined as passive? Like, what's the philosophical difference to the government?
If we look at the operational reality of the two assets, it actually makes perfect logical sense from the IRS's perspective.
Okay.
Think about how a property functions when it's rented out for 3 or 4 days at a time to different people. You are dealing with constant turnover.
Right. New people every week.
You have to constantly market for new guests. You're arranging for the property to be cleaned multiple times a week. You are restocking toilet paper, coffee, linens.
It's exhausting just hearing about it.
Right. You're dealing with daily guest communications, handling immediate maintenance emergencies like a broken smart lock at 11 p.m., and you're managing dynamic pricing based on local weekend events.
You are acting like a traditional landlord at that point. You're acting like a hotel manager.
That is the exact economic reality the tax code is recognizing here. The IRS looks at a property with an average stay of under 7 days and says, this isn't a passive real estate holding where you just collect a check once a month. This is a high turnover hospitality business.
And businesses generate active income and active losses.
Exactly. Yeah. A long-term lease where a tenant moves in, brings their own furniture, sets up their utilities, and lives there for a year.
Yeah.
That's a fundamentally different economic activity. The STR loophole is simply the tax code acknowledging the intense operational demands of short-term lodging.
Which brings us to a massive practical takeaway for you, the listener. Because this exemption is purely mathematical, it means you have to be ruthlessly protective of that average stay number.
Oh, fiercely protective.
Let's say you have a beautiful short-term rental in a seasonal market. January is a dead month. No one is booking. And someone reaches out on the platform and offers to rent the property for a single, unbroken 45-day stay. They say, hey, I'm renovating my house nearby. I'll pay you a premium to just stay here for a month and a half and help you cover the mortgage for the winter. It sounds like an absolute blessing.
A blessing that could trigger a complete tax nightmare.
Because of the average.
Yes. You have to do the math very, very carefully before accepting a booking like that. If you take a single 45-day booking, you have just severely skewed your annual average upward.
Right.
You will have to hustle to book dozens of one-night or two-night stays for the rest of the year just to drag that mathematical average back down to 7.0 or below.
And if you don't...
If December 31st rolls around and your average stay for the year sits at 7.1 days, you legally fail. Rule 1.
Wow. Just for point 1.
Yep. The IRS automatically reclassifies the property back to a passive rental activity, the loophole slams shut, and any active deductions you were planning to use to offset your IRA withdrawal are instantly quarantined.
That is a terrifying mathematical knife edge to live on. I mean, a single long booking could blow up your entire tax strategy for the year.
It really could.
But let's assume we navigate that, right? We keep our average at 4 days. We know how to generate these magical active losses. Now we need to look at how people actually attempt to use them.
Right, the application of it.
As we've established, the golden goose here is using these active losses to offset the massive tax hit of pulling money out of a traditional retirement account. But this brings us to the first catastrophic trap highlighted in the guide.
The expense versus investment trap.
Yes. It is the danger of confusing what the IRS considers a deductible expense with what they consider a capital investment.
This is where the internet dreams start to collide violently with the reality of an accountant's balance sheet.
Yeah, let's break that down.
Let's establish the baseline rules for the money you're accessing. When you take a distribution from a traditional IRA, not a Roth, but a standard pre-tax traditional IRA, every single dollar you pull out is treated by the IRS as ordinary income in the year it's withdrawn.
Because you deferred the taxes years ago when you put the money in.
Exactly. The IRS demands those taxes the moment you take the money out.
Meaning if I pull $100,000 out of my traditional IRA to buy an investment property, the IRS simply adds $100,000 to my taxable salary for the year. So if I make $80,000 at my job, the IRS now taxes me as if I made $180,000. That could easily bump me into a much higher, far more punitive tax bracket.
That is the ultimate threat. So the entire goal of the STR loophole strategy is a matching game.
A matching game?
Yeah. You want to ensure that for every dollar of ordinary income you create by tapping the IRA, you generate a dollar of active loss from the property to cancel it out.
Achieving a net zero tax event.
Exactly. Net zero. But you can only generate those offsetting losses on things the IRS explicitly allows you to deduct in year one.
Okay, let's build the list then. What are the safe, deductible items I can actually spend my IRA money on in that first year?
In year one, you can generally deduct repair and maintenance materials used to get the property ready for guests.
Okay, that makes sense.
You can deduct the furnishings, the beds, the linens, the appliances, the decor, which you can often fully deduct using bonus depreciation. You can deduct the mortgage interest paid that year, property taxes, insurance premiums, platform fees like Airbnb's cut, utilities, and even your travel expenses, flights, gas, hotels, to and from the property to work on it.
Assuming you keep immaculate receipts, I imagine.
Oh, absolutely. Contemporaneous receipts are mandatory.
That sounds like a pretty long list of things I can write off. So, where is the trap? What are the non-deductible items that ruin people's plans?
The devastating ones. The purchase price of the land itself is never deductible.
Because land doesn't depreciate.
Exactly. Land, in the eyes of the IRS, does not depreciate. The principal payments on your mortgage are not deductible.
Right.
You cannot pay yourself an hourly wage for your own sweat equity labor and deduct it. But the biggest trap, the one that ruins carefully laid financial plans every single day, is the down payment.
Wait, the down payment on the house is not a deductible expense, even if I pull the money straight from my IRA to pay it.
The down payment is not considered an expense at all in the eyes of the tax code. It is a capital investment.
Okay. Let's round this in reality by looking at one of the incredibly helpful scenarios provided in the source material. Let's look at Vincent.
Poor Vincent.
Right. Vincent is 59 years old. He lives in Tennessee, and he just took early retirement. He wants to buy a $210,000 short-term rental cabin near a popular lake resort. To fund this dream, he decides to pull $55,000 from his traditional IRA.
And we really need to look at exactly how Vincent allocates that $55,000.
Okay.
He uses $35,000 of it to cover the required down payment to secure the loan. The remaining $20,000 goes toward buying drywall, paint, and paying contractors to get the cabin ready for the rental market.
And according to the guide, Vincent's tax preparer, who clearly wasn't specialized in this specific STR strategy, told him, hey, you can write off those repairs so that will offset the IRA distribution.
Right, which is partially true, but wildly misleading in context.
Because Vincent hears that, does some quick mental math, and assumes the entire $55,000 withdrawal is now magically tax neutral. He thinks he's completely safe.
But the IRS math does not align with Vincent's mental math at all.
Where does it break down?
Only the $20,000 spent on repair materials and contractors generates a year one operational deduction.
Okay.
The $35,000 that Vincent used for the down payment, that generates absolutely zero immediate deductions.
Because, as you said, it's not an expense. But if you are Vincent, you are looking at your bank account and that $35,000 is gone. It left his account. Why doesn't the IRS care that he spent the money?
It's common frustration.
It feels incredibly counterintuitive. The IRS essentially punishes you for being responsible and putting your own money into the equity of the house, but they reward you with tax breaks for ripping up the carpets and painting the walls.
It feels punishing if you think of your IRA money simply as cash leaving your wallet.
Yeah.
But you have to shift your perspective. You have to think like an IRS auditor looking at a balance sheet.
Okay, how does an auditor see it?
The IRS doesn't view the down payment as money you spent or lost. They view it as a transfer of value from one asset column to another.
Oh, I see.
You took $35,000 liquid cash from your IRA, and you converted it into $35,000 worth of illiquid equity in a piece of real estate.
The value didn't disappear, it just changed shape.
Exactly. You still hold it on your personal balance sheet. Because your net worth didn't actually decrease, there is no loss or expense to deduct.
Okay. I didn't spend the money. I just moved it from a liquid bucket to a solid brick-and-mortar bucket. I still own the bucket.
Precisely. Whereas the $20,000 you gave to a plumber and spent on paint at Home Depot, that money is permanently gone.
Right.
It is a true operational expense of running your new hospitality business. That is why the IRS allows you to deduct it against your income.
So what is the fallout for Vincent?
It's bad. Vincent withdrew $55,000 in taxable income, but he only generated $20,000 in deductions to offset it.
So there's a gap.
A huge gap. He is left with $35,000 of fully exposed ordinary income that he wasn't planning for.
Oh, wow.
Based on standard tax brackets, the guide estimates Vincent is going to get hit with a surprise federal tax bill of somewhere between $8,000 and $11,000 when he files his return.
And that is before we even discuss state income taxes.
Exactly. He completely derailed his retirement math because he didn't understand the fundamental difference between spending operational money and investing capital.
If I am listening to this and I want to avoid Vincent's fate, what should I do? Like, what should a skilled, specialized CPA have told Vincent to do differently if he didn't have $35,000 in outside cash lying around for the down payment?
A CPA who understands the intricacies of STR financing would have advised Vincent to completely restructure the capital stack of the deal.
Restructure how?
They would have told him to finance the down payments separately, perhaps using a portfolio lender, pulling a home equity line of credit, a key LOC on his primary residence, or utilizing some sort of creative subordinate financing structure.
To avoid touching the IRA for the equity.
Right. The goal is to ensure that every single dollar pulled from the traditional IRA is strictly 100% earmarked for immediately deductible expenses. You have to match the taxable event to the deductible event, dollar for dollar.
But let's be realistic here. Let's say you can't find creative financing. You don't have a primary residence with equity to tap. Let's say you absolutely have to use the IRA money for both the down payment and the repairs, exactly like Vincent did.
Okay.
You are staring down the barrel of that exposed $35,000 in taxable income. Is there any legal way to artificially generate more deductions in year one to cover that gap without actually spending more of your cash?
There is, and it is arguably the most powerful, complex tool in the entire STR strategy arsenal.
I love the sound of this.
If you need to manufacture massive year one deductions without spending more cash out of pocket, you deploy an engineering-based tax analysis called a cost segregation study.
That brings us to one of the most fascinating mechanisms in the guide, cost segregation. I love this concept because the name sounds so dry and technical, but the core idea is basically financial time travel.
That's a brilliant way to phrase it, financial time travel.
It's all about manipulating the speed at which a house ages on paper, right?
It is the strategic manipulation of depreciation.
Mm-hmm.
Under standard IRS rules, if you buy a residential rental property, the physical building itself, not the land, but the structure, depreciates over 27.5 years.
And if it's commercial?
If it's a commercial property, it depreciates over 39 years.
Okay.
That means if you buy a house, you can only write off a tiny fraction of its purchase price each year as a paper loss for wear and tear. It is a very slow, agonizing drip of tax benefit.
But a house isn't just a single monolithic block of wood and stone. It is an assembly of thousands of different parts, and common sense tells us they don't all age at the same speed.
Exactly.
The concrete foundation might last a century, but the cheap carpet in the living room is going to be destroyed by guests in 5 years.
And that reality is exactly what a cost segregation study proves to the IRS. You don't just guess. You hire a specialized engineering firm.
Real engineers?
Real engineers. They physically or virtually dissect the property. They break it down component by component and legally reclassify those individual parts into much faster depreciation schedules.
So it's like dissecting the house with a scalpel, isolating the fences, the fridge, the custom cabinets, and fast-forwarding their aging process so you get the tax credit for their entire lifespan today instead of waiting a decade or 3.
That is the exact mechanism. The engineers reclassify these components into specific IRS buckets.
What kind of buckets?
Well, you have the 5-year personal property bucket, which includes things like kitchen appliances, carpeting, custom light fixtures, window treatments, and furniture.
Okay.
You have the 7-year property bucket, which might include specific specialized equipment. And you have the 15-year land improvement bucket, which covers things outside the physical structure, like landscaping, paved driveways, fencing, and patios.
Okay, so reclassifying them means I can write them off in 5 or 15 years instead of waiting 27.5 years. That is definitely faster, but how does that solve Vincent's immediate problem?
Good question.
Because 5 years is still too slow. If I am facing an $11,000 tax bill this year because of my IRA withdrawal, I need the deduction today.
This is where a crucial, time-sensitive piece of tax legislation supercharges the strategy. According to our source material, in July 2025, a piece of legislation known affectionately as the One Big Beautiful Bill was passed.
The One Big Beautiful Bill. You have to love the branding on congressional tax bills.
Regardless of the name, the impact is profound. It reinstated a provision called 100% bonus depreciation.
Oh, wow.
This is the magic wand for STR investors. It dictates that any asset reclassified into those 5, 7, or 15-year buckets during the cost segregation study does not have to be depreciated over those timeframes.
Seriously?
Because of bonus depreciation, you can elect to deduct 100% of their assessed value in year one, the very first year you place the property into service.
That is staggering when you think about the scale. So instead of taking a $500 deduction for the living room carpet every year for 5 years, I take the entire $2,500 deduction the year I buy the house.
Let's walk through the actual math the guide provides for a hypothetical property to see the scale of this.
Yeah, lay it out for me.
Imagine you buy a $220,000 short-term rental property. The engineering firm conducts their study, and they determine that about 15% of the purchase price can be reclassified as 5-year property. The appliances, the flooring, the fixtures.
Which is how much?
That equates to $33,000. Because of 100% bonus depreciation, that entire $33,000 becomes a year one tax deduction instantly. They also determine another 8% of the property's value consists of 15-year land improvements, the driveway and the fencing. That's another $17,600. Boom. Year one deduction.
So before we have even talked about the money we spent on repairs or the interest we paid to the bank, the engineers have just magically manufactured over $50,000 in paper tax deductions out of thin air.
Then you add in your actual cash expenses.
Yeah.
Let's say you had $25,000 in repair materials funded by your IRA, $8,000 in new furnishings you bought, and an estimated $12,500 in year one mortgage interest.
Okay, so add it all up.
When you tally all of that up, that seemingly modest $220,000 property could yield an estimated $96,100 in total year one deductions.
Almost $100,000 in tax deductions on a $200,000 house in the first 12 months.
Exactly.
That is the massive lever we needed to solve the IRA down payment problem. Let's look at Patricia's scenario from the guide to see this specific solution in action.
Yeah, Patricia's case is the perfect counterpoint to Vincent. Patricia is 55. She is a school teacher in Indiana, and she is a first-time investor.
Okay.
She finds a $235,000 cabin in Tennessee that she wants to buy and operate as an STR. She uses $40,000 from her traditional IRA to pay for extensive repairs. But, like Vincent, she also needs cash for the down payment. She needs $23,500.
So she is pulling $63,500 total from her IRA, exposing all of it to ordinary income tax. And based on what we learned from Vincent, we know that the down payment portion is the trap because it doesn't create a deduction.
But Patricia's CPA understands the game. They order a cost segregation study on the cabin immediately after purchase. That engineering study yields between $42,000 and $58,000 in year one bonus depreciation.
Incredible.
You add that newly manufactured depreciation to the $40,000 in actual repair deductions she generated. Patricia's total year one deductions land somewhere between $82,000 and $98,000.
Which is more than enough to completely swallow the entire $63,000 IRA withdrawal.
Yes.
It covers the repairs, and it creates a massive surplus of deductions to cover the exposed down payment gap, leaving her with zero tax liability on the distribution. It's brilliant.
It's textbook execution.
But we need to talk about the cost of entry. A cost segregation study isn't something you can just do yourself on a Saturday afternoon with a tape measure, right?
Absolutely not. The IRS requires the study to be defensible, meaning it must be conducted by qualified professionals, usually specialized engineering and tax firms.
So what does that cost?
The guide estimates a cost segregation study on a property of Patricia's size might cost between $3,000 and $5,000 upfront.
Okay.
But look at the return on investment. You are spending $4,000 in cash to unlock $50,000 in immediate tax deductions.
Right. The math makes sense.
Depending on your tax bracket, those deductions could save you $15,000 to $20,000 in actual federal tax payments that you would have otherwise had to write a check for.
It is an incredibly lucrative tool. It is the secret sauce that makes the STR loophole mathematically viable when you are forced to pull down payments from a traditional IRA.
Exactly.
Okay, so if I'm a listener, I am feeling pretty invincible right now. We have successfully hacked the passive loss rules by keeping our average stay under 7 days. We have used structural engineering to fast forward the depreciation of the driveway. We have $90,000 in tax deductions ready to wipe out our massive IRA tax bill. We feel like absolute tax geniuses.
You feel like you've won the game.
But this is exactly where the strategy hits a massive, unyielding brick wall. Because the IRS does not just hand you a $90,000 active tax deduction for signing a deed and paying an engineer.
No, they do not. The IRS requires you to prove that you earned those active deductions through actual documented sweat equity.
Here we go.
This brings us back to the second rule of the STR loophole we mentioned at the very beginning, material participation. And this is the exact threshold where passive investors, doctors, lawyers, and tech workers who just want to park their money and forget about it get completely destroyed in audits.
Right. The IRS has 7 distinct, highly specific tests to prove material participation. You only need to pass one of them to qualify for the loophole.
Just one.
Test 1 seems to be the gold standard the IRS prefers. 500+ hours of participation in the activity during the year. If you hit 500 hours, you are mathematically bulletproof. But let's be real. 500 hours is a massive amount of time for a single rental property, especially if you have a full-time job.
It equates to nearly 10 hours a week, every single week of the year, dedicated solely to managing that one specific rental.
That's practically a part-time job.
For most W-2 employees with families, that is incredibly difficult to sustain unless they are doing a massive, months-long physical renovation themselves. So the most practical test, and the one that Jhenesis Guide highlights as the absolute lifeline for STR self-managers, is Test 3.
Okay, let's break down Test 3. What are the specific hurdles I have to clear?
Test 3 has 2 distinct prongs, and you must pass both.
Okay.
The first prong is straightforward. You must spend at least 100 hours participating in the activity during the year.
100 hours, that's roughly 2 hours a week. Very manageable for anyone responding to guest messages and managing pricing.
It is. But the second prong is the trap that ruins people.
What is it?
You must do more hours than any other individual involved in the property.
I need to clarify the wording there. Any other individual. Does that mean everyone else's hours combined, or does it mean any single person?
Any single person. Your documented hours must exceed the hours of the busiest single person you hire to help you.
Okay, if I am trying to figure this out mathematically, I see an immediate problem.
Let's hear it.
Let's say I own a successful property and I hire a professional cleaning crew to turn over my property between guests. Let's say I have 40 bookings a year. The cleaner spends 3 hours per turnover. That's 120 hours just for the cleaner.
Right.
My 100 hours of remote management no longer cuts it. Won't their hours instantly dwarf mine? How does any self-manager legally pass this more hours than anyone else test if they don't clean the toilets themselves?
This is exactly where the strategy falls apart for people who don't understand the nuances of the IRS definitions. First, to clarify the cleaning crew example, which is the most common point of confusion.
Yeah.
The IRS test looks at the hours of each individual worker, not the vendor company as a whole.
Oh.
So if your cleaning company sends a different employee every time, you measure against the individual. If cleaner A logs 40 hours over the year, cleaner B logs 40 hours, and cleaner C logs 40 hours, and you log 105 hours of management, you still win.
Because I beat the individuals.
You did more hours than any single individual.
Oh, wow. Okay, so you are racing against the individual human being, not the corporate entity they work for. That is a massive relief.
It is a relief, but here's the ultimate non-negotiable trap the guide warns about, and it is where people lose their deductions.
Lay it on me.
You absolutely cannot hire a full-service property manager or a dedicated co-host.
Let's look at the Okafor family scenario to illustrate exactly why a co-host is a death sentence for this strategy. Kwame is a hospital administrator. Yemi is a physical therapist. They buy a beautiful STR in Arizona. They both work demanding jobs in Illinois, so they don't have time to run it daily. They hire a local Arizona Airbnb co-host to handle everything.
Think about what a co-host actually does. They manage the online listings, they respond to every single guest message, they coordinate the schedules for all the cleanings, they manage the dynamic pricing algorithms daily, they handle the 2 a.m. calls when the HVAC breaks.
Right, they do all the heavy lifting.
That co-host is easily putting in 150, 200, maybe even 300 hours a year on that property.
And meanwhile, Kwame and Yemi might put in, 20 hours a year reviewing the monthly financial statements and paying the property tax bill.
Exactly. Because the co-host's hours vastly, undeniably exceed the Okafor's hours, the Okafors immediately fail test 3.
Oh, no.
They don't have 500 hours to fall back on test 1. Therefore, they fail material participation entirely.
And what's the consequence?
The consequence is immediate. The IRS reclassifies the property, it defaults back to being a passive rental activity, the STR loophole vanishes, and they cannot use any of those manufactured cost segregation losses to offset their income.
So they're stuck.
They are stuck relying on the property purely for operational cash flow and long-term appreciation, and their tax strategy is completely ruined.
So the lesson is clear. To survive test 3, you have to be the primary manager. You have to be the quarterback.
You have to be.
But what if the property is out of state? The guide mentions Patricia, the teacher in Indiana, buying in Tennessee, or the Okafors in Illinois buying in Arizona. Are there geographical rules? Does the IRS look at your zip code and automatically assume you can't be materially participating if you live 3 states away?
What's fascinating about this section of the tax code is that the rules are entirely hour-based, not geography-based. You can live in Illinois and own a cabin in Arizona.
Okay, so the distance itself isn't illegal.
The IRS does not explicitly penalize you for the distance. However, the distance massively increases your audit risk profile.
I can imagine.
An IRS auditor will naturally and rightfully be highly skeptical that you are materially participating in the day-to-day operations of a hospitality business located 1,500 miles away from your primary residence.
So when that audit letter inevitably arrives in the mail, how do you prove it? What is the standard of evidence?
Documentation is absolutely everything. You must meticulously track every single minute you spend on the business.
It's down to the minute.
Yes. The Jhenesis Guide is very clear about what standard of evidence survives an audit. You need daily time logs, and they must be maintained contemporaneously, meaning you write it down that day or that week.
Right.
You cannot try to reconstruct your hours 6 months later in an Excel spreadsheet right before tax season by guessing how long a phone call took.
So it looks like Tuesday, 10 a.m. Spent 45 minutes on the phone with the plumber negotiating a repair. Friday, 8 p.m. Spent 2 hours adjusting weekend pricing algorithms on Airbnb and responding to 3 guest inquiries.
Yes, high levels of detail. Furthermore, you need flight, hotel, and gas receipts to prove the exact dates you were physically present at the property.
Okay, that makes sense.
You need Airbnb and VRBO activity logs exported to show your digital footprint of remote management. You need email archives proving you are the one actively communicating with guests and coordinating contractors, not an assistant.
It's all about proving you did the work.
Exactly. Patricia, the Indiana schoolteacher, made this work because she strategically spent her summer breaks physically at the property doing in-person renovations, which logged a massive chunk of uncontestable hours.
Ah, smart.
Then she meticulously logged her remote management, answering guest texts, ordering supplies online, managing the cleaners for the rest of the year to maintain her lead.
I am listening to all of this, the 7-day average limits, the cost segregation studies, the meticulous hour tracking, and it really just sounds like you were taking on a part-time job.
It is a part-time job. That is the entire philosophical premise of the STR loophole. You are getting a massive business tax deduction because the IRS recognizes you are running a business.
Sweat equity.
Sweat equity is the mandatory price of admission. If you want passive income, you accept passive losses. If you want active tax breaks, you have to do active work.
Okay, if you are listening to this and your head is spinning from cost segregation and 100-hour time logs, take a breath. Let's assume we are ready to put in the work.
Deep breath. Let's move forward.
We have the tax strategy dialed in. We have the cost segregation modeled with our CPA. We've set up our obsessive time-tracking spreadsheets. We actually have to go buy the house. We have to finance the dream.
The fun part. Or the hard part, depending on how you look at it.
And according to the guide, if you walk into your local traditional bank in 2026 and ask for a conventional mortgage for a dedicated short-term rental, you are in for a very rude awakening.
You're going to face near instant rejection. Financing a dedicated STR is fundamentally structurally different from financing a primary residence or a standard long-term rental property.
Why is that?
Conventional loans, the kind Fannie Mae and Freddie Mac, rely heavily on your personal DTI, your debt-to-income ratio. They look at your W-2 wages and your personal tax returns to see if you, the human being, can afford the monthly payment.
Right, the standard mortgage process.
But think about what we just discussed. If you are aggressively using the STR loophole and 100% bonus depreciation, your personal tax returns are going to show massive manufactured paper losses.
Ooh. To a conventional underwriter, looking at your 1040, you look incredibly broke. You look like you have negative income.
Exactly.
Which means I will fail the DTI check instantly, even if the property itself is an absolute cash cow making $5,000 a month on Airbnb. The conventional bank only sees the paper loss I created to save on taxes.
The irony is painful, but true.
So what is the solution? How do these investors actually get loans? Enter the DSCR loan. Let's slow down and unpack that acronym because it is the engine of modern real estate investing.
DSCR stands for Debt Service Coverage Ratio. These loans have become the absolute bedrock of the short-term rental industry.
How do they work?
They operate on a completely different paradigm of lending than the mortgages most people are used to. Instead of qualifying the borrower based on personal tax returns, DTI and W-2s, a DSCR loan quantifies the property itself based on its projected rental income.
So they care about the asset's performance, not my personal coffee habits or my salary.
Exactly.
How exactly is that math calculated? What is the DSCR formula a bank uses?
It is a simple division ratio. The lender takes the projected monthly rental income of the property and they divide it by the monthly debt obligations of the property. Those debt obligations are referred to in the industry as PITA.
Okay, you just threw out PITA. Let's slow down for a second because I know from my own mortgage that the monthly payment is never just the sticker price of the house. Break down what that actually includes when a bank is stress testing an investment property's obligations.
PITA stands for Principal, Interest, Taxes, Insurance, and any applicable association fees, like an HOA. It represents the true, unyielding floor of what it costs that property to simply exist every single month.
So let's run a hypothetical. If the STR is projected to generate $3,000 a month in gross rental income, and the PITA, the mortgage, taxes, insurance totals $2,000 a month, the bank divides $3,000 by $2,000, and they get a ratio of 1.5. What does that number mean to the lender?
That's the mathematical baseline. A ratio of 1.00 is exactly break even. The property makes exactly what it costs to operate. Most DSCR lenders consider a ratio of 1.25 or higher to be the optimal safe zone. It means the property generates 25% more income than it needs to survive.
Nice.
If you hit 1.25 or above, and you put down a standard 20%, you unlock the best interest rates. The 2026 guide lists those optimal rates as sitting between 5.875% and 7.375%, usually requiring the borrower to show 2 to 3 months of cash reserves in the bank.
And what happens if the ratio is lower? What if the property isn't projected to make quite that much and the ratio comes in at, say, 0.70?
The lending terms get aggressively worse because the lender takes on much more risk. If your ratio drops below 0.75, meaning the property operates at a significant monthly loss, the lender will severely drop the maximum loan-to-value ratio.
Meaning I have to put more down.
Exactly. Meaning instead of putting 20% down, you might have to put 30% or 35% down. The interest rates will spike aggressively, often above 9.50%, and the lender might demand you have 12 to 18 months of cash reserves sitting liquid in the bank just to approve the loan.
That is a steep, steep penalty for a low-performing property. Now, the guide has a massive warning section here regarding refinancing that I found fascinating. Let's say you buy the property using a DSCR loan, you execute the tax strategy perfectly, and year one goes great.
Best case scenario.
In year two, national interest rates drop, and you want to refinance to save some money. Why is that specific action so dangerous for an STR investor?
Because investors frequently forget how their brilliant tax strategy violently impacts their future financing options.
What do you mean?
Think about it. If the STR loophole worked exactly as you planned, you successfully push massive active losses, say $90,000, onto your personal tax returns to wipe out your IRA distribution. When you go to apply for a standard conventional refinance to get a lower rate, the underwriter pulls those recent tax returns, sees a massive negative personal income, and denies the loan instantly.
Because on paper, you're destitute.
Exactly. You literally cannot qualify for a conventional refinance because your tax strategy was too successful at making you look poor.
You outsmarted yourself right out of a conventional loan product.
That is the exact trap. You must plan for a DSCR refinance from day one. You have to know that when you refinance, you will need to use another loan that ignores your tax returns and looks only at the property's performance.
Right, keeping it focused on the asset.
And to get a good rate on a DSCR refinance, lenders usually want to see at least 12 months of documented, proven rental history on the platform. You can't rely on projections anymore. You need proof.
That brings up a fascinating structural problem with the initial purchase. How does a bank actually figure out what a short-term rental is going to make before you buy it? Because if I buy a house to rent on a 12-month lease, it's easy. The appraiser just looks at what other identical houses in the neighborhood are renting for.
Right.
But STRs are entirely different beasts. They fluctuate based on seasons, weekends, and management skill.
And this specific disconnect is where deals go to die every single day. It is called the appraisal gap.
The appraisal gap, how does that happen?
When an appraiser values a property for a conventional loan, they use the sales comparison approach, and to estimate the rent, they use an industry form called Form 1007. The critical flaw is that Form 1007 estimates long-term market rent, not short-term potential.
So they look at what a local family would pay to live there year-round. Let's use an analogy to understand how absurd this is. It is like trying to price a thriving, wildly successful restaurant by only appraising the value of the brick walls, the stoves, and the tables, and completely ignoring the line of 100 paying customers waiting out the door.
That's a perfect analogy.
You are entirely missing the value of the business operating inside the box.
That is the exact disconnect happening every day. The conventional appraiser values the bricks, not the hospitality business. Let's say you have a house that could easily generate $3,800 a month on Airbnb because it is located near a popular beach or a ski resort.
Okay.
But if a local family rented it year-round, the market rate is only $1,300 a month. A conventional appraiser fills out Form 1007, slaps a $1,400 monthly income projection on the property, and submits it to the bank.
But wait, if my DSCR loan is based entirely on the income ratio, if the bank thinks it only makes $1,400, my DSCR ratio is going to be terrible. It will probably drop below 0.75. I won't get the loan, or I'll get hit with a 9.5% interest rate.
Exactly. If the rent projection comes in low, you face an appraisal gap. The bank says, the ratio is too low, so we will only lend you 65% of the purchase price instead of 80%. Suddenly, you, the buyer, might have to bring tens of thousands of extra dollars in cash to the closing table just to make up the difference and maintain the required loan-to-value ratio. Most investors don't have an extra $40,000 sitting around a week before closing. The deal falls apart.
So how do you fight that? How do you force the bank to look at the line of customers out the door instead of just the bricks?
You have to be incredibly proactive. You must demand an STR-specific appraisal from your lender up front before you ever pay for the appraisal.
How do you do that?
You explicitly ask your DSCR lender, do you use the income approach, and do you accept AirDNA market data? AirDNA is the industry standard data provider that actively tracks actual Airbnb and VRBO revenue in real time.
Oh, okay.
If the lender uses AirDNA to calculate the DSCR ratio, they evaluate the property based on its true $3,800 a month short-term potential, not its $1,400 a month long-term potential. That completely changes your ratio and saves your loan.
That is a phenomenal deal-saving tip. Ask about AirDNA before you even apply for the loan. Now let's pivot the conversation, because everything we have talked about so far involves extreme hustle.
So much hustle.
Managing cleaners, obsessing over the 7-day average, fighting appraisers, tracking your hours. I guarantee some investors get exhausted just thinking about this. So naturally, human nature takes over, and they try to pivot to a strategy that seems safer, more stable, with less turnover.
Medium-term rental.
Yes, they pivot to medium-term rentals, or MTRs. And according to the guide, this seemingly innocent pivot triggers a massive tax landmine.
It absolutely does. MTRs have exploded in popularity over the last few years. These are stays typically booked on platforms like Furnished Finder, usually catering to traveling nurses, corporate relocations, or remote workers trying out a new city.
The 30 to 180-day crowd.
Exactly. Investors love them because you still get premium, fully furnished rent, but you only have to clean the place, communicate with the guest, and find a new tenant a few times a year instead of 3 times a week.
Operationally, it sounds like the perfect middle ground. You get the higher income without the part-time job of running a hotel.
Operationally, it is wonderful. Tax-wise, it completely destroys the strategy we've been building.
Let's look at the IRS reality here. What happens to the STR loophole when you rent a property to a travel nurse for a 3-month contract?
The STR loophole, by explicit IRS mathematical definition, vanishes instantly. Remember the golden rule 1. The average rental period must be 7 days or fewer.
Right, the 7-day rule.
If your average stay is 30 days, 60 days, or 90 days, you mathematically fail the test. The IRS reclassifies the property. It is no longer considered an active business. It legally defaults back to being a rental activity.
And as we discussed at the very beginning of this deep dive, rental activities generate passive losses. And passive losses are quarantined. They cannot offset the ordinary active income from your massive IRA withdrawal. Let's look at Marcus's story from the guide to see how this plays out in real life. Marcus is 38. He recently inherited $60,000 in a traditional IRA, and he wants to buy a coastal property in South Carolina for $195,000.
Okay.
He wants to rent it exclusively to travel nurses for 30-day minimum stays. He plans to pull $25,000 from his inherited IRA to do some repairs, assuming he can just write it off under the loophole.
If Marcus had proceeded without consulting his broker at Jhenesis Mortgage, he would have walked blindly into a disaster.
Oh, completely.
His broker looked at his plan and warned him. Because it is an MTR with 30-day stays, the losses generated by the repairs and depreciation are strictly passive. He cannot use those repair deductions to offset the $25,000 IRA withdrawal.
Which means taxes.
He would owe an unexpected $5,500 to $7,000 in taxes on that withdrawal, and those beautiful repair deductions would just get trapped on his tax return as passive losses, carrying forward uselessly year after year until he generated other passive income.
That is brutal. So what was the solution? Did Marcus just abandon the deal?
No, he pivoted his operations to save the tax strategy. His CPA confirmed that if he switched his operational model, he listed the property on Airbnb for nightly and weekly stays and aggressively managed it to get the average stay down to 4 or 5 days, the exact same physical property with the exact same IRA distribution would suddenly qualify for the STR loophole.
So he had to willingly accept the higher workload, the constant cleaning, and the constant guest messaging of high turnover simply to save the tax strategy.
Yes. And as a bonus, his projected gross income actually doubled by moving to premium nightly rates, though his operating costs for cleaners and supplies increased as well. But the primary goal of the tax strategy was saved.
Okay, I have a theoretical question. What if I try to outsmart the math? What if I use a mixed-use strategy?
Oh, yeah.
Let's say I have one travel nurse stay in my property for 2 solid months in the winter when tourism is dead. That's a 60-day stay. But then, for the remaining 10 months of the year, I aggressively cram in a bunch of 2-night weekend stays. I just keep churning 2-night bookings to drag the mathematical average for the entire 12-month period back down under 7.0 days. Can I legally do that?
You can. It is mathematically and legally legitimate under the IRS rules, but it is an incredibly dangerous game to play.
Really? Why?
It requires obsessive quarterback-level tracking of your data. You're playing a high-stakes game of averages, and a single unexpected event can ruin your entire tax year.
Walk me through a scenario where that mixed-use strategy blows up in someone's face.
Let's say it is late November. You've had your 60-day travel nurse, you've churned your weekend stays, and your average for the year is sitting safely at 6.5 days.
Sounds safe.
A guest books a standard 3-night stay. But on day 2, they get severely sick, or their car breaks down, or a massive snowstorm hits, and they ask to extend their stay by an extra 10 days. You are a good host, and you want the revenue, so you say yes.
I can see where this is going.
That single unexpected extended booking might be the mathematical weight that pushes your annual average from 6.5 to 7.1 days.
Oh, wow.
And the penalty is absolute. You don't just lose the loophole for November and December. The loophole evaporates for the entire tax year. All those deductions you carefully generated with your cost segregation study back in February, they instantly revert to passive.
That's devastating.
The strategy is blown because of one extended stay. If you choose to play the mixed-use game, your CPA needs to monitor your days quarterly, if not monthly, to ensure you aren't drifting toward the cliff.
Okay, before we leave the MTR topic, the guide mentions a weird, highly specific middle ground, the 8 to 30-day gray zone.
Ah, the gray zone.
If my average stay is, say, 14 days, I fail the 7-day test, but I'm not a full 30-day MTR. Is there any hope for me to claim active losses?
There is a secondary, much more difficult exception written into the tax code. If your average stay falls between 8 and 30 days, you can only escape passive status if you provide significant personal services.
What exactly does the IRS consider significant personal services? Because if I leave a nice bottle of local wine on the counter, a handwritten welcome note, and give them the high-speed Wi-Fi password, does that count as significant?
Not even close. The IRS sets the bar incredibly high. They mean services akin to a luxury hotel.
Like what?
Daily housekeeping while the guest is actively occupying the property. Dedicated concierge services, booking tours and restaurants. Meal preparation and delivery. Turn-down service.
Wow, so an actual hotel?
Yes. Simply cleaning the property between guests does not count. Providing basic utilities and trash removal does not count. You essentially have to run a boutique, fully staffed bed and breakfast to qualify in the 8 to 30-day window. For 99% of normal STR investors, it is logistically impossible.
So the takeaway is clear. Stick strictly to 7.0 days or fewer. No exceptions, no gray areas. Now, as we move into the final major section of the guide, I can imagine some listeners are feeling incredibly overwhelmed.
It is a lot of information.
We have talked about tracking hours on spreadsheets, fighting appraisers with data, living on mathematical knife edges with stay averages, and the terrifying threat of the IRS reclassifying your property. Some people are definitely thinking, I just want to invest my retirement money in real estate. I believe in the asset class, but I do not want a second job. I don't want to do all this work.
And that is a completely valid, rational feeling. Real estate, when done actively, is exhausting. If you want a truly passive experience using your retirement funds, there is a distinct path. But it fundamentally changes the rules of the entire game. You have to abandon the STR loophole entirely and look at utilizing a self-directed IRA.
An SDIRA.
Let's use Linda's scenario from the guide to understand how this radically different approach works. Linda is a 62-year-old widow. She has a traditional IRA with $210,000 in it.
Okay.
She wants to buy a beautiful $175,000 mountain cabin in New Mexico as an investment, but she explicitly does not want to trigger a massive taxable distribution by pulling the cash out into her personal bank account. And she definitely, under no circumstances, wants to be managing cleaners or tracking her hours on a spreadsheet.
So Linda's financial advisor sets up a self-directed IRA structure. Here is the fundamental mechanical difference between this and everything else we have discussed. Linda isn't pulling money out of the IRA to buy the house.
She isn't.
The IRA itself is buying the house. The SDIRA is the legal entity listed as the owner on the deed. Wait, the retirement account itself owns the physical cabin. It's not just holding stocks and bonds, it's holding a deed to a property in New Mexico.
Yes, the property becomes an asset of the retirement account. And because the money never actually left the protective, tax-deferred bubble of the IRA, there is zero taxable distribution. Linda does not pay a single dime of ordinary income tax on the purchase.
That sounds incredible. If you can buy real estate tax-free, why doesn't everyone just use an SDIRA and skip the 100-hour tracking nightmare?
Because the trade-offs are absolute, and they are incredibly restrictive. When the SDIRA owns a property, every single transaction related to that property must be strictly arm's length.
Meaning what?
Linda cannot personally manage the property. She cannot swing a hammer to fix a loose deck board. She cannot even legally change a light bulb or mow the lawn. Everything must be hired out to third-party professionals, and this is critical. Those professionals must be paid directly from the funds held inside the IRA, not from Linda's personal checking account.
So it is forced, legally mandated passivity.
Exactly. Furthermore, the IRS strictly forbids a concept called self-dealing. Linda cannot vacation in that cabin for even one single night. Her children cannot stay there for a ski weekend. It must be exclusively 100% used as an investment vehicle.
What happens if she breaks that rule?
If she spends a weekend there, the IRS can and will disqualify the entire IRA, treat the entire account balance as a fully taxable distribution, and hit her with massive life-altering penalties.
So the STRA route is like buying a high-end, remote-controlled race car that you are legally forbidden from ever driving yourself. You get to own it, you get to keep it in the garage, you get to watch it win races and generate prize money, but the second your finger touches the steering wheel to experience it, the IRS disqualifies you from the sport entirely.
That is a perfect analogy. You are strictly an observer of your own wealth generation.
But I have a question about the financing. What if Linda's STRA doesn't have enough cash to buy the cabin outright? What if the IRA only puts down 35% and gets a loan for the rest? Does the IRA owe taxes on the income generated by the bank's money?
You have just hit on the most dangerous blind spot in the SDRA world. UDFI. Unrelated debt-financed income.
UDFI. Okay.
If Linda's SDRA uses a non-recourse loan to buy the property, meaning the bank can only seize the property, not Linda's other assets, if it defaults, the IRS looks at that leverage very closely. If the IRA put down 35% and the bank financed 65%, the IRS determines that 65% of the rental income generated by that property was created by non-IRA money.
Right.
Therefore, that 65% portion of the income is subject to UDFI tax, which the IRA must pay.
Wait, so even inside the supposedly tax-sheltered protective bubble of the IRA, you can still get hit with taxes if you use leverage to buy the asset?
Yes. The IRS did not allow you to use borrowed money to generate tax-free returns inside a retirement account without taking a cut. It's a massive shock to investors who think SDRAs are completely tax immune.
And what happens to the rental income the cabin generates after any UDFI taxes are paid?
The net income flows directly back into the SDIRA, tax deferred. But here is the critical point tying back to our main topic today. Because the income and the expenses are sheltered entirely inside the IRA entity, they do not appear on Linda's personal tax return.
I see.
Therefore, the STR loophole, the strategy of creating active losses to offset your personal W-2 income, is entirely irrelevant and unavailable. You cannot use losses generated by a property owned by your SDIRA to lower the taxes you pay on your personal salary.
Because you and the IRA are two completely separate tax entities. They are two completely different philosophies of wealth building.
That is the ultimate takeaway. The STR loophole is an active, aggressive, hands-on strategy designed to minimize current personal income tax today. The STRA is a passive, conservative, hands-off strategy designed for long-term wealth preservation and growth for tomorrow.
You have to choose your game.
Exactly. Mixing up which game you are playing is the easiest way to get severely penalized by the IRS. If you want the personal tax deduction, you have to own the property in your own name and do the grueling work. If you want it totally hands-off and tax-deferred, you use the SDIRA, accept the restrictions, watch out for UDFI, and give up the personal tax deduction. You cannot have both.
We have covered an immense, staggering amount of ground today. We have mapped the minefield from Section 469 all the way to UDFI. Let's recap the critical checklist that every single listener needs to take away from this deep dive before they talk to their CPA.
Sounds good. Number one, never ever use IRA funds for the down payment if your goal is to generate a year-one tax deduction to offset the withdrawal. Remember, Vincent, the down payment is a capital investment, not a deductible expense.
Number two, if you have a down payment gap and need to manufacture deductions, model a cost segregation study with your CPA. Use that 100% bonus depreciation from the one big beautiful bill to fast forward your depreciation and artificially create the paper losses you need to survive.
Number three, document your hours relentlessly and contemporaneously. You must meet the 100-hour threshold, and you must prove you worked more hours than any single cleaner or contractor. And absolutely do not hire a full-service property manager or co-host if you want the loophole to survive an audit.
Number four, when you're financing the dream, plan for a DSCR loan and aggressively demand an STR-specific appraisal that utilizes AirDNA data to avoid the catastrophic appraisal gap. Don't let a conventional underwriter value your thriving hospitality business like a passive brick building.
And number five, guard your average rental period with your life. Keep it strictly at 7.0 days or less. Say no to the lucrative long-term winter booking if it mathematically threatens your annual average.
This has been incredibly tactical, but before we wrap up, I want to step back. You always have a way of looking at the macro implications of these dense tax codes. When you look at all of this, the loopholes, the incentives, the depreciation schedules, what is the bigger picture here?
If we connect this highly specific tax strategy to the broader landscape of real estate and housing in this country, it raises a profoundly important question. We just spent an hour detailing how the United States tax code offers massive active tax deductions, huge life-changing financial incentives to investors who buy homes and turn them into short-term vacation rentals.
Yeah.
But if that exact same investor buys that exact same house and rents it long-term to a regular family living and working in that community, the IRS restricts them to passive losses, which are far less financially lucrative.
Wow. When you frame it like that, the government is actively picking winners.
It makes you wonder, is the IRS inadvertently, through the mechanics of Section 469, financially incentivizing investors to convert quiet residential neighborhoods into high-turnover vacation hotbeds?
That's a scary thought.
We talk constantly about zoning laws and local city councils shaping the nature of our cities. But are federal tax loopholes quietly, invisibly designing the actual geography of our communities? Are we, through the tax code, financially rewarding the creation of temporary lodging over permanent housing? It is something to seriously mull over the next time you walk through a neighborhood where every third house has a digital lockbox on the door.
That is a staggering thought to leave on. Are tax loopholes designing our geography? Wow. Well, to you listening, if you are staring at your retirement account balance, dreaming of that A-frame cabin in the mountains or that condo on the beach, remember the video you saw online. It wasn't entirely a myth. The cheat code is real.
It's very real.
But as we have learned today, the code is hundreds of pages long, written in dense IRS legalese, and if you press the wrong button, it deletes your high score and empties your wallet. So please take the lessons from this deep dive, take your notes, and march straight into a specialized CPA's office before you sign a single contract. Let them guide you through the minefield.